I'm Stan Barnes, and I'm here with Eddie Hatch, and we're Barnes Capital Group. Well, welcome to episode 9 of Barnes Quarterly, and for those of you that I've not spoken with, want to wish you a happy 2021. Obviously, a lot's been going on in the world, and we wanted to, this is a little bit later than we wanted to release this edition, but because we were waiting to sort of see how this first of the year opened up with regard to corporate earnings, presidential elections, Senate elections, and many other things. But at any rate, we're going to spend most of our time on this edition visiting with Chris Zaccarelli, who's going to give us a recap of last year and maybe talk about some of the current events that are unfolding for the current year, 2021. Eddie, why don't you catch us up on what's been going on around the office?
We're finally getting settled into our new office. We've been here almost a year now, so we've finally got things going the way that we wanted them set up. But we also just wanted to remind everybody that we do have the capabilities. If you're still not comfortable coming in for face-to-face meetings, we do still have the ability to handle virtual meetings. We also, several of the tools we use like Riskalyze and eMoney, we have the ability to share screen online with you. So if you are still interested in meeting, we can always set up something virtually if you're not comfortable coming in.
And we seem to have an increased interest in doing that. And it's not just to make sure that you stay COVID conscious, but just from a convenience standpoint, sometimes it's easier to do it from the comfort of your home and your desk there than to come in and meet with us. And we're totally good with that. I will tell you that if you do come into our offices, the management staff here is very sensitive to cleaning, and you do check in at the front desk, and they check your temperature, and they require a mask in the common areas. So hopefully rest assured that you are coming into a safe environment. Well, we've got Chris Zaccarelli with us this morning, coming to us from North Carolina. And Chris, thanks for taking time out to visit with us for a little bit.
Well, thanks so much for having me back. It's always great to speak with you.
If you could give us maybe a quick recap of what went on in 2020, if that's possible. And we're obviously have 2021's off to an eventful start. We've got a new president in office. But let me just pause for a minute and let you sort of give us a little retrospective on 2020.
Well, 2020 was really an extraordinary year. Obviously, it impacted all of us, and we all felt it going through the pandemic, the lockdowns, and then the reopening of the economy. So I'm sure there's no one on the planet that hasn't felt strongly about 2020, and in most cases, pretty negative terms. However, obviously, it was very surprising, at least in the beginning, how well the stock market held up during 2020. And so I think that's the big story from a market's point of view. Is that despite the fact that we had this global pandemic and such an economic shock, the market was able to rally back and actually end the year in such a positive fashion. And so with the benefit of hindsight, it's not so surprising that the market did well, just given how much the Federal Reserve and the federal government did in terms of providing fiscal and monetary stimulus. And there's really two reasons why the stock market did as well as it did, despite the fact that the economy took such a hit. And the first reasons are the amount of liquidity that was injected into the system. And then the other reason is just the stock market obviously doesn't reflect the entire economy, to the extent that the entire economy has millions of small businesses and hundreds of thousands of business owners who ended the year not only much worse than they started, but in some cases without a business at all. And so the amount of pain and suffering that took place is really unprecedented. On the other hand, those 500 companies that make up the S&P 500, a lot of them did very well. And in the case of some of the largest companies in the index, they actually ended up the year better off than they started. And so what you have within the stock market index is that index of the 500 largest companies in the United States, many of whom actually benefited from the pandemic. And that's an unfortunate thing in terms of the actual human aspect of everything. But for those of us who are invested in the stock market and have our life savings and our retirement wrapped up in that index to some extent, one way or another, it actually turned out to be not as bad as feared originally. And so I think really 2020 is kind of that tale of two cities, that idea that despite the fact that there was such an economic impact and things were so bad on the ground, financial assets, and for those of us who are invested for our retirement, ended up not at all as bad as originally feared. And so I think that's the silver lining to what was otherwise a pretty awful year.
And wouldn't it be fair to say that the fact that the Fed's action of taking interest rates basically to zero also tends to make the stock market look more attractive for investors who are looking to generate a reasonable return?
That's absolutely true. Really, the Fed, the way they're able to act on the market and the real economy is in both those ways. One is lowering interest rates, which not only make car loans, mortgages, any types of credit that's extended to individuals, as well as corporations that are looking to issue their own debt. It makes all of those ways of getting credit back to the users of credit much more easy and at a lower cost. In addition, the amount of liquidity that they provided to the system, the idea that banks were not going to run out of money, the fact that you had a lot of money within the financial system and there wouldn't be any types of runs on the bank or squeezes in terms of people who needed access to cash, that really settles everything down from a market's point of view and really provides that cushion and gives people the confidence that they can go forward and continue to transact both in the market as well as continue to run their operations in the real economy, so to speak. So the Fed really was the game changer in terms of stopping things from happening like they would have happened again, similar to the financial crisis, in terms of having this huge stoppage of the financial markets, an incredible drop in the market, and it would have taken a lot longer for the market to recover, specifically because of what the Fed did, how they did it, and how quickly they did it. The stock market recovered much more quickly in 2020 than we saw the recovery in 2008 or 2009.
Well, there's certainly no shortage of topics to talk about here for the first part of the year. Obviously, one of the major themes is the elections that took place and changing of the guard in the White House, as well as some changes in Congress. Obviously, I know we got a fair number of calls from clients that were a bit anxious about what impact that might have on the market. If you could just kind of comment on sort of the change in the winds in Washington and maybe what impact that's had on the markets.
So the impact to markets, at least from the political situation, it's complicated. I think if you look over the longer term, and so let's say at least 2 to 3 years, 5 years, 10 years down the road, absolutely the types of policies that Congress and the president put into place will have an impact down the road, both in terms of potentially higher taxation and as well as regulations and some types of disincentives or incentives for businesses. It will create winners and losers to some extent farther down the road. But the immediate impact to markets is what's happening with fiscal stimulus and monetary policy. And so we already talked about the Federal Reserve, and they are incredibly accommodative at this point, really making monetary conditions easy. That's a very big tailwind for the stock market, regardless of what's happening in Washington. In addition to that, at least in the short term, you have a political party, the Democrats, who are marginally in control of the Senate with a 50-50 tie and a tiebreaker from the vice president. They were already in control of the House, and as you mentioned, they now control the White House. So the fact that Democrats are in control of those three seats of power in the short run is likely to create more spending. And so we're actually seeing that this morning, the morning that we're recording this call, that Democrats are inclined to spend in very large amounts. So we might see a $1.9 trillion fiscal package. You could argue that if we had a different president or if you had a divided Congress, that amount would be far lower. And so in the short run, what you're actually likely to see is the stock market move higher because there's so much fiscal stimulus being put into the market, as well as the Federal Reserve staying easy. And so for any of those people who are concerned about what the current political situation will mean to financial assets, if anything, this might actually make their assets go higher in the short run. What we really need to worry about is what's going to happen 2 years out, 3 years out, 4 years out. A lot can change between now and then, and I would still argue that the Federal Reserve will almost always be the elephant in the room, which will be a larger factor than what's happening in Washington. But at least in the short run, at least for 2021, you wouldn't be surprised to see financial assets continue to move higher. As we turn the corner and go into 2022 and beyond, we'll see what happens with the Federal Reserve. We'll see what happens with the coronavirus, the vaccine rollout, and all of those factors. And then I think it will make sense to look at, what are the potential policies that may slow growth down in the future. But for now, it's to some people paradoxically a good thing that Democrats are in power, at least for the stock market.
So given the fact that we do have a Democratic president and largely Democratic Congress, I know that one of the sectors of the market that seems to have been catching fire over the upcoming years and has really caught fire last year and going into this year is a term that our listeners may not be familiar with, known as ESG investing. Could you talk about that for a minute and explain what it is?
This idea of ESG investing, which is an acronym for environmental, social, and governance. So we're looking at the environment, looking at the social aspect of corporations, and then looking at corporate governance, which is the idea of how companies are managed, is an idea that's been around for a couple decades. And really the Rockefeller Foundation, which clearly made all their money from energy, created almost a new paradigm in the sense that they said they were going to divest of all of their fossil fuels and carbon energy holdings. They really kicked off this movement that's putting focus on companies to focus more on not just on profits, but on the way in which they run their businesses. So on the one hand, this is a marketing term. On the other hand, it's a change in philosophy. And so you really need to treat it for what it is, which is be aware that some of the issues that are brought up by this type of investing are here to stay and are changes, possibly for the better when you're looking at corporate governance at least. I think it makes a lot of sense that corporations are not run like dictatorships, but truly represent all of the stakeholders. And some of the reforms that have been pushed along those lines, I think, make sense regardless of how you feel about the environmental aspects. The social and environmental pieces, I think, are more controversial, and as you'd expect, they fall more along party lines. And so I think what you're seeing with ESG is both a marketing term as well as a change in philosophy. And so with that in mind, I'm both skeptical of the approach, because anything that's really a marketing type of scheme, to me, should be dealt with at arm's length. On the other hand, to the extent that you're looking at trends or concepts that are going to be with us and shape things going forward, you need to pay attention to it. And so I think with ESG, you're going to find a combination of both. You're going to find companies that are looking at their environmental impact, their social impact, and their corporate governance, and they'll make substantive changes. And it's worth watching to make sure that, first of all, does that hurt their profitability, and us as investors, does that make them less attractive? Or are they doing it in a more holistic way, such that maybe instead of thinking about short-term profitability, they're thinking about long-term profitability? How do they make sure that their customers, their employees, and let's say the broader stakeholders stay involved and help their company as opposed to opposing their company, in which case, for the longer term, you actually may end up with a better result. So I think it's a very large topic. I think it could get very complicated as we get into the weeds, but it's something that more and more people are talking about. So I think it's definitely worth being aware of what it is and potential implications for us as investors.
Well, we might give that a little more time in future broadcasts, but another acronym that a lot of people have been hearing, particularly at the end of the year and first of this year, is the acronym SPAC. That stands for Special Purpose Acquisition Company or Corporation. Talk a little bit about that phenomenon and why it's getting so much airplay right now.
So these SPACs are something that are not new. They've been around for quite a while. However, they come in and out of fashion. Right now, they're very fashionable, and there's a lot of people that are rushing to create these SPACs, and a lot of people who are looking to invest in them. And so, one way to think about a SPAC is it's almost a way to be a private equity investor, and by that I mean you as a public market investor in a SPAC, where you can go ahead and buy a stock that trades on the stock exchange. That you have access to when you otherwise wouldn't as a private equity investor. You're providing capital to a group of people who will decide what they want to do with that capital in terms of what type of a private company would they like to buy, and then they will run that company similar to how a private equity firm might go out and buy a private company and then make changes on management. So with a SPAC, you have a limited period of time, typically 18 months, where you give the company the money to go out and buy whatever they want, and if they don't, they have to come back and return that money to you. So there is a little bit of a time pressure to use it, but again, you're really buying into something that pre-acquisition, you're just giving money to a group of people that you hope will do a good job with that money and buy a company that's worth owning. Now, after they go through the transaction and buy that private company, it's actually a backdoor way of going public. So under the normal IPO process, which a lot of us are familiar with, private companies will go on a roadshow, they will talk about their company, and then they will go public through an IPO. And I think most of our listeners are familiar with that IPO process. The SPAC really circumvents, yes, and the SPAC process really circumvents that whole process, because you immediately go from a private company to a company that's traded on the stock exchange without going through that IPO, initial public offering process. And so it's a much quicker way to go public. So for those private companies, a lot of them are interested in going public more quickly without all the scrutiny, time, and effort that's required to go on those roadshows and go through that initial public offering. On the other hand, there are a lot of fees that are generated by these SPAC owners, so they're very interested in pursuing it. And so I wouldn't necessarily say there's something bad about a SPAC or good about a SPAC. It's just a different type of a transaction. It's another way for a private company to go public. It has become very popular very lately because there are a lot of private companies that prefer to go public more easily. And it's very popular for all of these SPAC sponsors, the people who run the SPACs, because they can generate large fees, similar to the way private equity firms generate large fees, just for going out and finding a private company and bringing it public. So it's another term, and it's another trend, I would say, that we're seeing in the marketplace in much larger size than what we've seen previously.
Thanks for those explanations. We've covered a lot of ground in a fairly short period of time, but I think you've done it very effectively. So at any rate, thanks again for your time, and we will certainly be in touch.
Thank you. I really appreciate it. It's always great speaking with you, and I hope everyone is off to a good 2021. May this year be a lot better than last year.
Amen to that.
All performance referenced is historical and no guarantee of future results. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.